Two XRP headlines are circulating right now. One claims analysts expect the strongest XRP rally in history. The other says Ripple has confirmed XRP as a non-security, and a price surge could follow. Those are powerful claims. But when narratives like this start stacking, assumptions tend to grow faster than facts, and that's usually where confusion starts. Because once expectations form, people stop asking what's required for those expectations to actually play out. So instead of reacting emotionally, let's break down what these headlines really mean, and what they don't. The rally claim comes from a familiar idea. An analyst is pointing to a technical setup that looks similar to a past XRP cycle, a structure that appeared before a major move years ago. The logic is straightforward. A pattern appeared before a rally followed. The pattern appears again. So a similar outcome might happen. That's the full argument. There's nothing deceptive about it, but it's important to understand its limits. This is the same reasoning traders use across crypto, whether it's Bitcoin cycles, Ethereum fractals, or altcoin breakouts. Sometimes it works, sometimes it doesn't. The difference is never the pattern itself. It's what's happening around it. Pattern-based arguments spread quickly because they feel objective. Charts look scientific. Lines look precise. But markets don't move because shapes repeat. They move because participants behave differently. Two charts can look nearly identical while being driven by completely different forces underneath. That's the part most pattern headlines leave out. It's like seeing the same weather pattern 2 years in a row and assuming the outcome must be identical, without checking temperature, pressure, or wind. The shape might look familiar, but the conditions underneath aren't. Earlier XRP cycles happened in a very different market environment. Back then, participation was narrower, liquidity was thinner, and price was far more reactive to smaller amounts of capital. Most activity came from retail traders. Moves were faster, sharper, and often driven by momentum rather than structure. Today's market operates differently. Liquidity is deeper, but it's also more fragmented. Capital tends to enter in stages instead of all at once, and large participants are far more sensitive to risk, timing, and confirmation. That changes how price behaves. Instead of sudden vertical moves, price often compresses. Instead of emotional breakouts, you see long periods of consolidation. Instead of instant follow-through, you get hesitation and retests. So even when a technical setup looks familiar, the forces behind it are not the same. The chart may resemble the past, but the market mechanics underneath it have changed. Phrases like "strongest rally in history" aren't just analytical, they're emotional. They trigger memories of past cycles when conviction paid off quickly. That doesn't make the comparison wrong, but it does mean the language carries psychological weight beyond the data, and that weight drives sharing more than certainty. When people hear historic, they don't hear probability, they hear opportunity. That's why this wording spreads so fast, even when the underlying claim is cautious. Now let's address the second headline. Ripple has reiterated that XRP is classified as a non-security in the US. That matters. It reduces uncertainty. It lowers friction. It makes participation easier for some players. But here's the key point. Removing a barrier does not automatically create demand. Legal clarity is like removing a speed bump. It doesn't press the accelerator. It just makes acceleration possible if someone wants to press it. Here's where things often get misleading. People stack the narratives. A familiar technical setup plus legal clarity equals an inevitable breakout. But these are different categories of information. One is technical interpretation. The other is regulatory context. They don't guarantee outcomes when combined. They simply reduce uncertainty in different areas. This is how narratives turn into expectations, not because they're false, but because they're stacked without timing or confirmation. Price doesn't move because headlines sound convincing. It moves when real participation shows up. That means liquidity entering the market, not just trades, but commitment. It means volume expanding in a way that supports direction, not just volatility. And it means follow-through that holds after the initial move. You can often spot the difference. When moves are driven by narrative alone, they fade quickly. Volume spikes briefly, then disappears. Price struggles to hold gains. But when real capital commits, behavior changes. Pullbacks become shallow. Support levels start to hold, and price advances without needing constant explanation. That's what confirmation looks like in practice. Until those signals appear consistently, any setup remains potential, not proof. Headlines can attract attention. Charts can suggest possibilities. But price only responds when participation turns into sustained action. The right way to read these stories is simple. They tell you why XRP is being watched again. They do not tell you what will happen next. They describe attention, not inevitability. That distinction matters when narratives start getting loud. If a headline makes you feel like something must happen soon, that's usually a sign to slow down, not speed up. Yes, analysts are optimistic. Yes, regulatory clarity has improved. Those are real developments. But historic rallies aren't predicted in advance. They're recognized after markets prove them. Understanding that difference keeps you grounded and keeps headlines in perspective. That's the purpose of this channel. We are not here to call tops or bottoms. We're here to help you understand why narratives form and how to stay clear-headed when they do.